In this presentation, I want to talk about how to avoid common mistakes when placing market and limit orders. Common mistakes that could be avoided when placing market or limit orders. So, number one, you understand the purpose of each order type. Understand the purpose of either the market order or the limit order. So for market orders, prioritize speed suitable for liquid stocks when price precision isn't critical. We're talking about market order, talking about prioritizing speeds suitable for liquid stocks when um, precision is not very important. Then for limit order, it prioritizes price control suitable for volatile stocks or when targeting a specific price. These are what to take into consideration. You are targeting a particular price, then you set in a limit order. You're not too keen about a particular price. You key in a market order. Number two, common mistakes with market orders. Common mistakes with market orders. Mistake number one, using market orders in volatile markets. So how to avoid using market orders in a volatile market. In a volatile or thinly traded stocks, use limit orders instead to avoid large price discrepancy due to slippage. Wherever there's a kind of volatility or in a thinly traded stocks, it's important you use limit order so that you can get to buy the stock at the price you intend to buy it at. Because if you use a market order at that particular juncture, you may not get it at a suitable price, at a price you feel is cheap enough for you. And not only that, mistake number two, placing large market orders. Placing large market orders and how to avoid it. Break large orders into smaller parts to minimize market impact, especially for illiquid securities. If you place a large, a large market order, and you don't get to buy it at the expected price, that will avoid to unfavorable entry in the market, and that will really cost you much. All right, it will cost you much because you're not able to get the stock at the price you felt you could get it at. Number three mistake, trading outside market hours. Trading outside market hours and how to avoid it. Be cautious of using market orders during pre-markets or after market hour sessions when liquidity is low and price spread is wider. If you want to have a better execution, trade during the normal trading hour. That will give you the kind of price you really desire, or else you may end up buying at a price that is not really suitable, for you as an investor. You may end up buying at too high a price. Number three, common mistakes with limit orders. If we examine common mistake with market orders, we want to also look at common mistakes with limit orders. Mistake number one, setting unrealistic limit prices. Setting unrealistic limit prices. And how to avoid it. You research the stock's current trading range and set a realistic limit price to improve the likelihood of execution. For instance, now you bought a stock at $5. You don't set a stop loss at you don't set a limit price at a percentage too close to $5. All right, so that you could improve your likelihood of execution. Mistake number two, forgetting to specify order duration. Forgetting to specify order duration. So choose the appropriate time frame. Example, day order or good till cancelled to match your trading strategy. Generally, like the platform I use in my investing. Once you set a limit order, you'll be prompt to set the duration, or else the order will not be executed. It will simply indicate a star, and it will show, it will indicate red. That means I should go in and set the duration. It might be for a day, for 10 days, for 7 days, or whatsoever. You must set a duration. So mistake number 3, using limit orders for highly liquid stocks. Using limit orders for highly liquid stocks, and how to avoid it. For highly liquid stocks with narrow spreads, a market order might execute at an acceptable price, and you end up saving times as a result. Please like this video and subscribe to this channel. I'm trying to give you this explanation that when it comes to trading or investing, you know the kind of order you need to adopt. Doing a typical trading platform like the one I use, for investing, you have just 2 orders there: limit order and buy order. So you know which one to use and which one is more favorable to you at a particular point in time, or depending on your goal, your aim and objectives. So it's important you get to understand these kinds of orders. It will go a long way in helping you as an investor or even as a trader. Number 4, general mistakes and how to avoid them. General mistakes and how to avoid them. Mistake number 1, ignoring fees and costs. Ignoring fees and costs. So how to avoid it? Understand your brokerage commission structure, especially for frequent trades. Whether you like it or not, this is something you cannot avoid to ignore. When you buy, all right, let's say you want to sell a stock and buy another one the same day. Now look at the cost involved. First of all, you sell, okay, you are incurring a cost. Now you buy another stock, you're equally incurring a cost. So by the time you sum up these costs, discover that there is something very, particularly if you have a large, if you are selling, if you are executing trade that is worth millions, I'm telling you, by the time you calculate the cost, the charges, is something that will it's mind blowing. All right, let's say you want to execute another that is about maybe $1 million or $1 million. The commission alone may be up to as much as maybe $5,000 or above in cost, in fees. So mistake number 2, not monitoring open orders and how to avoid it. Regardless, you regularly check your pending orders, especially limit orders, as market conditions can change quickly. So monitor and see whether there's execution or not. All right, have the order been executed or not? Because there's that risk of slippage. Your orders may be left unexecuted. Number 3, overlooking market conditions and how to avoid it. Check news, earning reports, or market events that may cause price volatility before placing an order. Ask yourself, how volatile is the market before you place your order, so that you end up getting your shares at the price you feel is beneficial to you. Number 4, using the wrong order type for your goal. Using the wrong order type for your goal. These orders are there to be utilized at an appropriate time and under appropriate circumstance. If you use the wrong order type, it becomes a problem. So assess your priority, that is in speed versus price, and choose the appropriate order type. If you're looking for speed, go for market order. If you're looking you want to buy at a specific price or sell at a specific price, you go for limit order. Don't confuse the two, and don't misapply the two. So tips for both types of orders. Tips for both order types. Use stop loss orders in conjunction with market or limit orders to manage risk. Not only that, double check order details Example, stock ticker, price, and quantity before you confirm your order. Avoid emotional trading. Base decisions on research and strategy. So all these tips are very important for you as a trader or as an investor. Get to understand them, and I'm telling you, it will go a long way in improving your execution, getting your execution at the right price, at the price you feel is beneficial for you. You don't end up buying at a higher price or silver. You buy at a price that is in tune with your long-term investment objectives.